Listen to me very carefully, because what you are about to hear is being actively suppressed by the financial mainstream. Right now, as you watch this, the greatest physical wealth heist in modern human history is unfolding in real time. China has just triggered a silent, irreversible supply shock, and they are aggressively hoarding every single physical ounce of silver they can get their hands on under the $85 mark. If you think the recent silver rally to $120 was just a speculative bubble, you are falling directly into their trap. Today is Monday, February 23rd, 2026. The Asian markets have just reopened following the Lunar New Year liquidity vacuum, and the data pouring out of the Shanghai Futures Exchange is absolutely terrifying for Western banks. Silver is currently consolidating in the mid-80s, but beneath the surface, a tectonic shift has occurred. This isn't a conspiracy theory. This is a verifiable, structural breakdown of the global financial system. The paper silver illusion is collapsing, and the East is draining the West of its physical lifeblood. If you have your money sitting in a traditional savings account, or if you are holding paper silver ETFs thinking you are protected, you need to wake up right now. The rules of the game have fundamentally changed. The window to position yourself ahead of what Citigroup is now calling the gold on steroids supercycle is slamming shut faster than anyone predicted. The fear of missing out shouldn't be about chasing green candles on a chart. The real fear should be waking up to find out that the physical metal you thought you owned never actually existed, while Eastern superpowers hold all the cards. In this deep dive investigation, I am going to expose the hidden mechanics of China's January 2026 export ban, a move so secretive and devastating that it has permanently fractured the global silver market. But more importantly, I am going to reveal the specific mathematical trigger that will force Wall Street to default on billions of dollars in paper silver contracts. You must stick with me until the very end of this video, because I am going to show you the exact loophole the smart money is using to secure physical assets before the inevitable leap to $150 and beyond. Do not click away, because what I am about to share will directly impact your financial survival in 2026. Let's get straight into what is actually happening. To understand the magnitude of today's news, we have to look at the silent policy shift that happened on January 1st, 2026. On New Year's Day, while the Western world was recovering from holiday celebrations, Beijing implemented a draconian new export restriction on refined silver. Overnight, China, which controls a massive 60 to 70% of the global refined silver supply, placed silver under the exact same strict state-controlled export licensing regime that they use for rare earth metals. They restricted export licenses to only 44 massive state-approved companies, demanding verified credit lines of over $30 million and a minimum annual production capacity of 80 tons. In a single stroke of the pen, hundreds of mid-sized suppliers were blocked from selling to the West. Silver was officially upgraded from a mere industrial commodity to a highly protected national strategic asset, and the results have been immediate and catastrophic for global supply chains. Why does this matter? Because the world is currently running on empty. For 6 consecutive years, we have been operating in a severe structural supply deficit. In 2025 alone, the world consumed over 230 million ounces more than miners could pull out of the ground or recyclers could recover. That is equivalent to the entire annual mining output of Mexico, the world's largest silver producer, completely vanishing. Silver is no longer just the poor man's gold or a metal used for making shiny jewelry. It is the irreplaceable backbone of the 21st century technological revolution. You cannot build a single artificial intelligence data center without silver. You cannot manufacture an electric vehicle without using up to 80% more silver than a traditional gas-powered car. And most importantly, you cannot build a solar panel without it. Last year, the global solar industry consumed staggering amounts of silver paste, and China currently installs more than half of all new solar capacity worldwide. Beijing knows that the future of global energy, military dominance, and technological supremacy relies entirely on this one reflective metal. They are not about to let Wall Street paper pushers dictate the price of their future. And here is where we uncover the hidden trap, the secret snare that Western investors have been lured into for decades. It is called the paper-to-physical ratio. For years, the global silver price has been manipulated and suppressed by futures traders on the New York COMEX and the London Bullion Market Association. They trade derivative contracts promises of silver rather than the metal itself. At its peak, the ratio of paper silver traded to actual physical silver sitting in the vaults was a staggering 356 to 1. Think about that for a second. It is like a real estate developer selling the exact same house to 356 different families, collecting the money from all of them and just praying that they don't all show up on moving day with the keys. Well, ladies and gentlemen, moving day has arrived. The trap has been sprung. institutional investors, family offices, and Eastern central banks are suddenly calling the bluff. They are demanding physical delivery, and the Western vaults are bleeding dry. We don't have to guess if this is happening. The data is 100% verified and absolutely undeniable. Just a few days ago, on February 9th, CEIC data revealed that silver inventories available for delivery on the Shanghai Futures Exchange plummeted to just 318 tons. That is the lowest level in nearly a decade. Meanwhile, COMEX registered inventories in the United States have collapsed by nearly 70% since 2020. Major banks are being forced to rewrite their forecasts in a panic. Citigroup has publicly projected silver to hit $110 in the short term, with a bull case of $150, citing an acute shortage of physical metal. JP Morgan, which has historically been deeply intertwined with silver market making, now admits silver will average $81 throughout the entirety of 2026. This isn't fringe internet speculation. This is the consensus of the very institutions that used to short the metal. The panic is real, and the math does not lie. Before we go any further into how you can protect yourself from this massive squeeze, I need to hear from you. Are you currently holding physical silver in your own possession, or are you relying on paper ETFs like SLV? Drop a comment down below right now with the word physical or paper. I read every single comment, and I want to see how prepared this community actually is for the historic default that is brewing. If you are struggling to grasp how a market can function without the actual underlying asset, let me give you a relatable example. Imagine you go to a car dealership to buy a brand new, highly sought-after sports car. You pay in full, in cash. The dealer shakes your hand, smiles, and hands you a legally binding certificate that says you own the car. But when you ask to drive it off the lot, he tells you the car is kept in a secure vault across the country for your convenience. Years go by, the price of the sports car triples because they stop making them. You decide you finally want to drive your car, so you take your certificate back to the dealer. But when you get there, you find a line of 300 other people holding the exact same certificate for the exact same car. The dealer only ever had one car. That is the global paper-silver market. And China just walked to the front of the line, kicked down the door, and drove the car off the lot while everyone else was left staring at their pieces of paper. Let's simplify the jargon for a moment. You keep hearing the term structural deficit thrown around. In plain English, a structural deficit means this isn't a temporary shortage caused by a passing storm or a minor labor strike. It means the actual physical machinery of global supply is fundamentally broken and cannot meet the baseline demands of humanity. Silver is a byproduct metal. Over 70% of the silver mined globally is accidentally found, while companies are digging for copper, zinc, or lead. This means that even if the price of silver skyrockets to $200 an ounce today, mining companies cannot just instantly double their silver production. They would have to mine massive, unprofitable amounts of copper and lead just to get to the silver. The supply is completely inelastic. It does not stretch to meet demand. And with AI data centers and military-grade semiconductors requiring highly conductive materials, the demand curve is going vertical while the supply curve is flatlining. Let's look at the hard data from the solar sector alone. In 2025, global solar installations surged by another 10%. Even though manufacturers are desperately trying to thrift and use less silver per panel to save costs, because silver now makes up nearly 30% of the cost of a photovoltaic module, the sheer volume of solar panels being produced is overwhelming those efficiency gains. The solar industry is currently sucking up roughly 6,000 metric tons of silver every single year. And remember, China dominates this sector. They installed roughly half of all new global solar capacity last year. They are looking at this data and realizing that if they allow the West to buy up all the cheap silver, China's own domestic solar and EV manufacturing engines will stall. So what did they do? They imposed the January 1st export ban. They are trapping the silver inside their borders. They are hoarding the physical metal under $85, letting the Western derivative markets bleed themselves dry. But I have to be completely candid with you. This is not a straight line to infinite wealth, and the volatility is meant to shake you out. Let's talk about the risks and the extreme uncertainty currently plaguing the market. If you were watching the charts in late January, you saw silver absolutely blast off to $120, only to face a vicious, violent pullback down into the 70s and 80s. Why did that happen? Because the Western exchanges, the CME, panicked. They aggressively hiked margin requirements, forcing smaller, over-leveraged traders to liquidate their positions. It was a manufactured crash designed to clear the board. Robert Kiyosaki, who has famously predicted $200 silver, warned about this exact scenario. He told investors not to give in to FOMO at the top, but to wait for the brutal corrections to accumulate physical ounces. The big banks want to induce volatility to scare retail investors away from physical metals. They want you to think it's too dangerous, too volatile, too unpredictable. But while you are being shaken out by margin hikes, the Eastern central banks are quietly buying up the physical dip. Let's do a quick recap because the puzzle pieces are all coming together, and you need to see the full picture before we get to the actionable strategy. First, we established that China instituted a shadow ban on silver exports on January 1st, restricting the flow of metal to the West. Second, we verified that physical inventories in Shanghai and London are plunging to decade lows. Third, we exposed the paper-to-physical trap, revealing that the COMEX is trading phantom ounces that do not exist. And fourth, we confirmed that industrial demand from AI and solar is creating an inescapable structural deficit. The stage is set. The physical run on the banks has already begun in the shadows. But the most critical part of this equation is what happens next. In just a moment, I'm going to reveal the specific indicators you must watch to know exactly when the paper market completely snaps and how you can position your portfolio to not just survive the crash, but to extract generational wealth from the greatest short squeeze in human history. If you are still watching this, you are already in the top 1% of investors who actually understand macroeconomic reality. Let's shift gears right now. Take a deep breath. We've covered the terrifying reality of the massive structural supply deficit and China's iron grip on the physical market. But fear without a plan is just panic. And panic is exactly what Wall Street wants from you. It is time to go on the offensive. It is time to look at the exact mechanism that will cause the final break in the silver market, and how you can position yourself ahead of the tidal wave before the $85 floor becomes the new normal. To see the future, we have to look at what is actively being ignored by the evening news. Right now, as we move through February 2026, the BRICS Plus nations are executing the final stages of a financial strategy that has been years in the making. They aren't just hoarding gold anymore. They have realized that silver is the Achilles heel of Western industry. India, for example, imported a mind-bending amount of silver throughout 2024. In 2025, we are talking thousands of tons. Why? Because they are aggressively building out their own domestic solar and electronics manufacturing base to compete directly with China. So you have the two most populated nations on planet Earth, both heavily industrializing, both completely dependent on silver, actively competing to drain the Western vaults. The West is trying to suppress the paper price to keep their technology and military supply chains affordable, while the East is happily using that suppressed, artificially low paper price to buy up all the actual physical metal. It is the greatest wealth transfer of the decade, happening right under our noses in broad daylight. And here is the psychological warfare aspect of this squeeze. Have you noticed how every time silver starts to break out, every time it threatens to hold above $85 or $90, there is suddenly a barrage of mainstream financial articles telling you it's a bubble or a poor investment. They will point to a sudden violent $2 drop on a Tuesday morning and say, "Look, the rally is over. Go back to buying tech stocks." That $2 drop is pure paper manipulation. It is a handful of massive hedge funds dumping thousands of naked short contracts onto the COMEX at 3 in the morning when the market is at its absolute most illiquid. They create a phantom price drop. Retail investors see the red candle on their screen, they panic, and they sell their physical ETFs. And who do you think is standing right there at the bottom to scoop up those shares? The exact same institutions that caused the crash. They are shaking the apples out of the tree, and retail investors are falling for it every single time. So how do you actually fight back? How do you protect your wealth and set yourself up for the massive upside when the COMEX finally breaks? Here are the exact actionable steps you need to take right now. Step number 1. You must prioritize physical metal in your own possession over paper promises. If you do not hold it, you do not own it. Start with recognized, highly liquid sovereign coins. I am talking about American Silver Eagles, Canadian Maple Leafs, or British Britannias. Yes, you are going to pay a premium over the spot price. That premium is not a penalty. It is the real-world cost of actual physical acquisition in a broken market. The spot price on your screen is fiction. The physical premium is reality. If silver rockets to $150, you are not going to care that you paid an extra few dollars in premiums back in early 2026. You're going to care that you actually have the metal in your safe when the music stops. Step number 2. If you are making larger investments and you absolutely must use a vaulting service or a trust, you must ensure that your account is explicitly labeled as fully allocated and segregated. Do not fall into the trap of unallocated accounts. An unallocated account means you are just an unsecured creditor to a bullion bank. You are basically giving them an interest-free loan, and they are using your money to trade paper derivatives. If that bank faces a liquidity crisis, and as we have seen with the massive drain on COMEX, that crisis is already here, your unallocated silver will be liquidated to pay off their biggest institutional clients. You will be left with pennies on the dollar and absolutely zero silver. Fully allocated means there is a specific bar with a specific serial number sitting on a shelf with your actual name on it. It cannot be leased out, it cannot be hypothecated, and it cannot be used to bail out a failing bank. Step number 3. For those with a higher risk tolerance looking for explosive leverage, you need to deeply research primary silver miners. But listen to me very carefully. Mining stocks are not a substitute for physical silver. They are an equity play. They carry massive operational risks, geopolitical risks, and management risks. However, because over 70% of silver is mined accidentally as a byproduct of copper and zinc, there are very few pure-play primary silver miners left on the planet. The ones that do exist, the ones with proven reserves in safe jurisdictions, are currently sitting on a powder keg of leverage. When the price of silver makes its next violent leg up, the profit margins of these specific miners won't just double, they will go parabolic. But you must do your own intense due diligence. Look for companies with low all-in sustaining costs, strong balance sheets, and operations in mining-friendly regions. Avoid companies that are drowning in debt or operating in jurisdictions that have a history of suddenly nationalizing foreign assets. Let's pause and do a quick reality check because the loop is closing. We have covered a massive amount of critical ground today. We started with China's secret January 1st export ban, which essentially choked off the global supply of refined silver. We looked at the terrifying reality of the paper-to-physical ratio and how the Western vaults are being drained at a historic pace to feed the insatiable demand of the solar and AI data center industries. We exposed the manipulation tactics used by big banks to shake retail investors out of the market with fake volatility, and we laid out a clear 3-step action plan to secure your wealth using physical possession, fully allocated storage, and strategic equity plays. The window of opportunity is not closing in a few years. It is closing right now in the first half of 2026. The mathematical reality is absolute. You cannot run a high-tech global economy on a structural deficit of nearly 250 million ounces a year without the physical price eventually breaking the chains of paper manipulation. This is your moment of truth. Are you going to be the person who watched this data unfold, understood the macroeconomic shifts, and took decisive action to protect your family's financial future? Or are you going to be the person who waits until silver is headline news on every major network, trading at $150 an ounce, trying to buy at the absolute top when all the physical supply is completely gone? The massive institutional money is front-running this trade right now. Central banks are front-running this trade right now. China has already locked the doors and is keeping everything for themselves. They are all preparing for the inevitable default of the paper market. You need to be prepared too. If this video opened your eyes to what is truly happening behind the curtain of the global financial system, I need you to do exactly 3 things right now. First, smash that like button. It tells the YouTube algorithm that this information is critical and helps push it out to other people who desperately need to hear the truth before the trap snaps shut. Second, hit subscribe and turn on the notification bell. The markets in 2026 are moving at breakneck speed, and I am going to be here bringing you the real-time data and actionable intelligence that the mainstream media is actively trying to hide from you. And third, share this video with one person you care about. Send it to a family member or a friend who is sitting entirely in cash or overvalued tech stocks, completely unaware of the currency crisis that is unfolding. Finally, I must remind you that I am an independent researcher and analyst, not a licensed financial advisor. Everything discussed in this video is for educational and informational purposes only. The financial markets, especially precious metals and mining equities, carry significant risk. You must always conduct your own thorough due diligence, consult with a certified financial professional, and never invest more money than you can afford to lose. Stay vigilant, stay prepared, and remember, if you don't hold it, you don't own it. I will see you in the next deep dive.